All right, guys, Chris Jackson here, investingwithchris.com, and also, obviously, you're here at the investingondemand.com website. And in this video, I'm going to be talking about how stocks are bought and sold. I get a lot of questions about which broker to use, and then how to start investing into stocks, buying shares, and whatnot. I think that you need to understand the fundamentals about how the stock market works, how those shares get traded around from person to person or investor to investor. So this is actually one of the segments within my course that I built for that's basically available over on the investingwithchris.com website. And I'm going to be showing you how I've broken it down and how it actually works as well to hopefully better explain how this stuff works. So first off, when understanding how shares are priced within the market, we must understand the overall perspective of how a company is divided into the shares. Once a company has went public within the stock market, it uses this strategy to raise capital for further growth and development needs. So we're going to be taking a look at ABC Corporation here, and we're going to see the graph and how it's broken down by the owner or board members, the majority stakeholders, and then how it's divided by you and I as the publicly individual traders and institutions. So as we can see, the company is divided into slices like a pie. When owning shares, you are the owner of that company and own pieces of the pie. However, the board or owners of that company itself control the majority of the shares. They control or own products within the company, such as chairs, all the management, all the overhead, and basically we own profits and voting rights. We don't own anything else. That's all we own. We own the profits and voting rights. None of the other stuff matters. So if we're assuming that the company is divided into 10 shares outstanding, we're going to take a small example, and the total value, which is called the market cap, of the company is $1,000, then the share price would be $100 each. So the owner, in this case, would get 5 shares, $500 total. Bob the investor would get 2 shares at $200. Carl the investor, 2 shares at $200. And then we have Susan with just 1 share totaling $100. Now the total market cap or market capitalization, which is the total value of the company, is $1,000. We get that by stock price times total shares outstanding equals the market capitalization. Okay, so how the market determines the price of the shares is due to the last price sequences. For every transaction in the market, there is a buyer and a seller. Market makers also are mixed into the equation and usually make their profits from the bid and ask spreads. So for the example, if someone's selling shares for $200 and someone has put in a bid to buy that for $190, a market maker will usually make their money within that spread, the $10. This is why the bid is usually lower than the ask price. Now, if Susan decided to sell her share that is $100 to Jim the investor for $200, now everyone's shares are now worth double due to Susan's share value doubling. So the owner and his shares or their shares now become $1,000. And then Bob $400, Carl $400, and Jim $200. Total market cap is now $2,000. If Jim or Bob or whoever decided to sell their shares, the price would then be adjusted again depending on the last price sequence. If the shares were sold for less, then the price would react to the negative impact and act the same way as it did when Susan sold her share to Jim. The whole process is similar to an auction, but not just moving up in price. The price of shares can go up or down depending on the owner's price set to sell their shares and willing to take them. The last price sequence is all that matters when it comes to the market's pricing and what shows on your side. So I don't want to go from anywhere from there. I just want you to get to understand how the prices work, how they're sold on the market, and go from there. They're basically last price sequence. So we as investors want the asset that we purchase to always go up in the future. That's common sense. The buying and selling of stock and their prices are solely based on investor assumptions and trading of prices. Most investors buy to hold longer than just one day. We did not purchase an asset for $300 and then want to sell it for $300 in the same day. As I was always told from a friend of mine, we are buying future price, not the current. So when we're investing, remember, I always stress on this intrinsic value formulation, but in the end, anything could happen when it comes to this whole, for example, COVID crisis, that just because something is valued one day might not be the same the next. Example, that when Apple's growth rate may be 20%, and you're forecasting that, and then all of a sudden something changes, and the next month that forecasting or that growth model, the percentage, is cut by 50%, that totally changes the ballgame, and therefore it will totally change the intrinsic value. So just remember, you're always buying for a future price. You can look at PEs, price to earnings ratio, and you can consider whether or not you're getting a decent buy. And just remember, on the price to earnings ratio, if it's a 15, that means for every $15 invested, you're making $1. So the lower the better, but that's not always the case, because sometimes in a growth stock for the first 5 or 10 years, depending on its growth phase, you may be paying 100 to 1. So the PE may be 100, maybe 40, who knows? But if it's growing, does it really matter? It just means that you're getting a better return rate. So just keep that in mind as well. So the key to analyzing the real stock of a value or value of a stock is intrinsic value is personal assumption based. When analyzing intrinsic value, areas that are often within the valuation is the average returns. These are often calculated based off the last 5 years, and then sometimes broken more detailed down by the quarters. Projection of years, growth rate in the next 5 years at a 15% rate. And then the terminal growth rate, this is the rate after the growth period, often based off an inflation rate, which is gathered from a 10-year bond rate. Years of terminal growth and discount rate. This is normally the average rate of return within the stock market, sometimes 9 to 11, sometimes 22%. Just keep that in mind. As you discount something, it's less risky. If you discount it more, then obviously, guess what? It's more risky. That's where these contracts and athletes come from. This is where future values and net present values are calculated, is that discount rate. So just keep that in mind. The 3 most used intrinsic value calculations are the discounted cash flow model, discounted earnings model, and the projected future cash flow model. This is a third option to use when DCF, discounted cash flow, or discounted cash flow earnings base cannot be calculated. The discounted free cash flow model focuses on free cash flow and total equity. These measures can be used to determine an intrinsic value estimate for a company. Sometimes the discounted cash flow earnings based cannot be assumed or calculated for the fact that they may have just came publicly known to the stock market. So obviously there's no earnings reports to go off of or no history. I'm going to give you this last slide for you, just to make the video short and sweet so you don't get bored with what I have to say. The beginners and those looking to trade stocks, sometimes day traders, do not care about intrinsic values, merely patterns within their charts. This again is the reason why many lose money versus those like institutions who evaluate stocks and assets before buying. If those who do their homework and believe the stock price is below the intrinsic value, then the change of buying the stock increases. If the price is higher than the intrinsic value, then it is understood that the stock price is overvalued and those currently holding on to shares may sell. This selling pressure is what drives stock prices down. For an added bonus, I'm going to add to this. At the end of the year, sometimes you'll see huge sell-offs. Sometimes at the beginning of the year. And why is that? Because companies are closing down their accounting measures, taking in their profits, So it's just easier to account for it. Or sometimes they sell at the beginning of the year, January, February, because they've already filed their taxes and they're ready to take those profits, put them to good use, so they have for the entire year, because obviously they don't have to pay taxes on anything until another 11 months out. And then what you're going to see is they put that money to use, they invest it, and then they basically pay the taxes on whatever is net profit at the end of the year. So they're cashing out at the beginning of the year, January, February, and then rolling those profits into something else and on down the line. So I hope this makes sense when it comes to how the stock market works, how those shares are constantly trading in between you and I institutions, and how those prices change from the last price sequence. If there's any questions, as always, provide them in the comments section of where you may find this video. Feel free to check out investingwithchris.com. And if this video may be on YouTube, like and subscribe. And also, check it out on investingondemand.com, where a lot of good stuff will be happening. For merely $9 a month, you'll have access to all my videos, all of my content from all of my previous courses, and a continuing learning that I hope that you'll take and provide a wealth in your portfolio. So that's it for this video, and I will see you next time.